So in this example, what we're going to do is discuss these bond liabilities that can be reported at fair value. So generally accepted accounting principles allow organizations to report their financial assets and liabilities at their fair value. And so what this basically entails is that for something like a bond, right? We're going to go through an example of a bond payable. What we're going to do is show essentially how that bond is accounted for using the effective interest method, right? So all along, that's what we've been using when we've talked about bond premiums and discounts, using the effective interest method to calculate each periodic interest payment, interest expense, and then the amortization of premiums and discounts. We're still going to follow that same process. But again, what generally accepted accounting principles allow is that at the end of the period, companies have the option to report their financial liabilities, something like a bond, at their fair value. So notice, again, that last bullet point, companies are not required to, but they have the option to value their financial assets and liabilities at fair value. What has to happen is that at the initiation of issuing the bond, the company would have to declare that, yes, we are going to use the fair value to account for this bond payable, for this financial liability. They can choose from one bond to the next, from one financial asset to the next. The company can sort of have a mix and match. They can have a mixed bag of some of their financial liabilities are reported at fair value, some are not. They can decide at the initiation of those financial assets and liabilities, when they initially begin to have them outstanding, they will decide at that initiation point whether or not they're going to use fair value accounting. So in the case of a bond liability where a company has elected to use the fair value accounting option, they would have to, at the end of the year, basically come up with the fair value of whatever that financial liability is. In our case, it's going to be a bond. And they would have to compare, okay, what are our current accounting records that when we use the effective interest method, what is the liabilities value versus what is the liabilities value using fair value methods? And they would have to figure out, does an adjustment need to be made based on the fact that our current book value is different than the current fair value of the asset or liability at the end of the period. And again, we're going to be focused, because all of Chapter 14 is focused on these financial liabilities like bonds. We're going to focus on the liability side of things. So here is the example that we are going to go through. You'll notice this information is the same as that was used for the bond discount problem. So we issued $700,000 of 12% bonds. They have a 10-year maturity period. Interest is paid semi-annually. And on the day that we issued the bonds, the market rate of interest was 14%. So what you'll notice, if I jump over to Excel to my fair value option tab, what you'll notice is that all of the data, all of the entries for this discounted bond are exactly the same as what we already did in the bond discount example. So in the bond discount example, we calculated that the present value of our bond was $625,842. We said that our market rate of interest is 14% divided by 2. Number of periods was 20. Our payment amount was negative $42,000. Our future value was negative $700,000, and then our type was 0. We did the same exact present value calculation that we've already done in the discounted problem, and we've calculated that the value of our bonds on January 1st of 2021, this should say 2021, let me change that, is $625,841. The journal entry that we make on the day that the bonds are issued is exactly the same as the other example that we've already done. We debit cash for the price of the bond, we debit discount on bond payable, and we credit the bond payable account for its face amount. Then, over the first year, we had 2 interest payments, one on June 30th, one on December 31st. Using the effective interest method, we calculate interest expense by taking our current bond value times the market rate of interest, and again, it's divided by 2 because this is semi-annual. Each and every 6 months, we have agreed to pay $42,000. That $42,000 is very simply taking the face amount times the stated interest rate of 12% and dividing it by 2. And then whatever the difference is between our effective interest expense and our interest paid is what we amortize down from our discount. So we start with a discount that has a debit of $74,000, and over time we slowly but surely amortize portions of that discount away with these credits. We come up with a new bond value by taking our previous bond value and adding the adjustment that we make to our discount, and then we do the exact same thing on December 31st. Interest expense is the value of our bond times the market rate of interest divided by 2. Our interest payment is $42,000, and the difference between our interest expense and our interest payment is going to be what we amortize away from our discount, the amount that goes away from our discount. So, as of December 31st, 2021, the bond value on our books, so this is our book value. The bond value on our accounting records right now is $629,586. That's 2 periods of amortizing our discount. Our bond value is $629,586. As it says in our problem, what we are going to assume is that on December 31st, the market rate of interest has fallen to 13%. So, because we have elected the fair value option, we know that this change in the market rate of interest, it was 14%, and by the end of the year, it's fallen to 13%. That's going to have an effect on the fair value of our bond. The book value is $629. We already calculated that. What we have to do now is figure out what the fair value of our bond is, because we have elected to record this bond at its fair value. We've elected that fair value option, so we're going to have to figure out what is the new bond value as of December 31st, 2021, knowing now that the market rate of interest has fallen to 13%. The way that we do that is by calculating the present value with this new market rate of interest. So, equals PV. Our interest rate, we just said, is going to be 0.13 divided by 2. Now, our number of periods. 1 year has passed, so we don't have 20 periods, right? We only have 18 periods left. Again, remembering that it's 10 years, but there are semi-annual interest payments. So each year we had these 2 interest payments, one on June 30th, one on December 31st. So we had 20 total number of periods, but now we've already accounted for 2 of them in that first year. So 20 minus 2 gives us the 18 periods. Our payment amount, we're still talking about interest payments of $42,000. Our future value, we're still talking about a face amount of $700,000. And our type, we're still talking about end of period interest payments. So, given this new market rate of interest, our bond, the fair value of our bond with this new market rate of interest is actually $663,486. Our book value, we already said, is $629,586. So when we figure out the difference between the fair value and the book value, we simply subtract the 2. The adjustment that we need in order to account for this bond at its fair value, which we just calculated to be $663 or $663,486, the adjustment that we need to get our book value up to the fair value is an increase in our bond payable of $33,899. So, what we want to do is have an understanding first, before we go to make that entry, we want to understand why did the fair value and the book value, why were they different? What was the cause of the difference? So if I go to slide 3, it says if the difference, if the gain or loss between the fair value and the book value is a result of a change in the general risk-free or market rate of interest, then we would simply account for that as a gain or loss related to the fair value. That gain or loss gets accounted for on our income statement. Normal gains and losses get accounted for on our income statement. So again, because in our example, what happened is that there was an adjustment to the risk-free rate that then impacted the overall market rate of interest in a bond that is similar to ours. So because it was an adjustment or a change in the general interest rates, that gain or loss, whatever it winds up being, needs to be accounted for in our everyday net income. So it's going to just be a simple gain or loss in our journal entry. If that gain or loss was a result of a change in our company's credit risk. So our company's credit risk has changed from the beginning of the year to the end of the year. If that's why the fair value is different than the book value, then notice we don't record that as a gain or loss and include it in our income statement. It gets accounted for in other comprehensive income. So if the change of book value to fair value is because of our company's credit risk, then that change, that adjustment, that gain or loss needs to be accounted for not in net income, but in other comprehensive income. And we're going to talk more about other comprehensive income when we get into chapter 17 and then even more so in chapter 18. But essentially, other comprehensive income is what we use to account for these types of gains and losses that normally don't happen all of the time, right? These are not in the normal course of our operation. So something like a change in the fair value of our bond, right, as a result of our credit risk, our company's credit risk changing, that's going to go into other comprehensive income. But our example is this one. There was an adjustment in the risk-free rate that caused a change to the market rate of interest. That created an adjustment that's needed of $33,899. What we are going to do is, again, if we are increasing the bond payable, we're saying the bond liability is currently $629,000. It should be $663,000. An increase in the liability creates a loss from that fair value adjustment. Debit $33,899. Now, what we are not going to do is continuously increase and decrease the bond payable account. Instead, we're going to use a temporary fair value adjustment to bond payable account. So this fair value adjustment account is what we're going to use to increase the overall value of our bond. So if now we look at our bond book value plus this fair value adjustment, what we will see is the new bond value on our accounting records as of December 31st, 2021 is $663,486. We use this fair value adjustment account and we essentially add and subtract it to the bond payable balance that's already on our books so that we can leave the bond payable balance alone. We don't want to continuously be debiting and crediting bond payable, but we do need to reflect the change, the addition to the bond value that came about as a result of a change in fair value. So we use a fair value adjustment account. We credit fair value adjustment for bond payable so that we can show these adjustments to the bond, this financial liability, this bond liability, without actually debiting and crediting the bond payable account itself. And then finally, we already said, but just to reiterate, when we choose to elect the fair value option, we have to do so when that item originates. So when we initially issue the bond, we would have had to declare we are going to use the fair value option. But we don't have to report all of our bonds at fair value. We don't have to elect this option for all of our bonds. We can pick and choose. We can mix and match. And remember, again, I'm going to go back to slide 28, that we are focused on this financial liability, this bond payable, but this also comes into play with financial assets. So not only do financial liabilities have this fair value option, the financial assets also have a fair value option. So we can keep that in mind as we continue thinking about these different types of